Welcome to How to Compete in a Mortgage Rate Lockdown Environment. Hi, I'm your host, Nicole Carpenter, Senior Loan Officer with Platinum Eagle Mortgage. I promise I will make this as brief as possible. I hope you will walk away with some great information that will help you navigate your business through the remainder of the year. So let's go over what's happening in the current real estate market of the second half of 2023. I found this quote and I thought it was really befitting. It goes like this: it's a capital mistake to theorize before one has data. It's from the famous Sherlock Holmes, who is a fictional character. Actually, the author is the author of this quote, but we'll just run with it. So in order for us to come to the realization of what the rest of the year is going to look like when it pertains to the housing market and the mortgage market, we must first take a step back and look at the bigger picture to see who our biggest competitor is. Competitor is not just home builders or other real estate agents in the industry or other lenders. It's actually the talking heads, media, social media, anything that's put out there that is not accurate. We all know that the media has a narrative of gloom and doom. They are here to sell advertisement. And when they have nothing better to say or nothing better to do, they use fear tactics to keep us listening. It is our jobs as professionals to educate our clients as we help them navigate through the home buying process or selling process. Just in case you haven't been listening to the media and the talking heads, this is some of the things they have been saying for the past few years about the housing market. For example, like we're in a housing bubble. October of 2015, Housing Today, a bubble larger than 2006. November of 2017, homeownership doesn't build wealth, study finds. 2019, the housing market is about to shift in a bad way for home buyers. Now, that's not a completely inaccurate statement. It did shift then, but for different reasons than what they indicated. Now, 2022, why the housing market is in an increasingly big trouble. Again, it's all gloom and doom, but if you'll notice here on the second chart, you'll see a steady increase in the average prices of a home nationwide has gone up anywhere from 5% year over year as high as 19% year over year. So what these talking heads in these little blips are saying as you're passing by your TV, as you're making dinner, washing dishes, or cleaning the house, they're putting out the negative information when actually the numbers are quite the opposite. This meme is kind of sums up the example of what we are dealing with when it compares to the media to us as the lender and real estate agent. They preach that the world's on fire right now, and we're out there asking if anybody wants to buy or sell a home. And all of our clients seem to have the gloom and doom, the world's on fire mentality. And that's exactly what we need to fight. So you see this next slide and you're wondering, why is she going to talk about births by year? Well, it's actually kind of important because it actually reflects inventory, how much inventory we have versus the people that need homes. So let's talk about this real quick. Some of you've heard me talk about this information before, so I'm going to go over it for just a moment for those who have not heard it. We are not in a housing bubble. We do not have enough homes for the people that need them. Let's take a look at the generations and their current population. As you can see in this chart, I have separated the generations from the silent generation, the baby boomers, the Gen Xers, yes, I'm a Gen Xer, those millennials, and post-millennials are what some like to call Gen Zers. I have been saying this for a while now for the reason why the housing crash in 2006 to 2009 was due to population. We had too many homes and not enough people. And if you'll notice here, I've earmarked it 1973, we had a dramatic drop in births over the next 5 to 7 years. And that is actually for something that happened at the Supreme Court. And what was that? That was actually Roe versus Wade. Let me say that again, Roe versus Wade. And we had birth rates drop for the next 5 to 7 years. Now let's fast forward 33 years later, where the average homeowner was about 33 years old when they bought their first home. That was 2006. And I will show you in some different charts to back that up. So not that this is a political statement or anything, but it just shows you that what happens 30 years ago can affect what happens today. So let's jump forward to the 1990s. If you'll notice that the current first-time home buyer, being 33 years old in 2023, was born then, and that population is much higher. So we, in fact, have not enough homes for the people who are wanting homes. And let's move on to the next chart, and I'll show you how that breaks down. This slide represents a formation of households and new home completions. The formation of households are in blue, and the completions of new homes are in yellow. I'm not going to bring up pre-existing homes. When one person sells a home and they buy another, it's a wash. Let's focus on new houses and housing completion. You can see here in 2005 to 2010, they were actually building more homes than formation of households. Do you think there ever was a builder that went back and looked at birth rates? Then add all those crappy lenders with those crazy loans, and that's how we get a housing crash. Now, don't say that builders do not learn from their past, because builders got scared and basically stopped building homes for the formation of new households starting in about 2011 until now. Then let's add the fact that people are living longer. Their quality of life is better, so they're staying in their homes longer, so those pre-existing homes aren't going to the new housing formations like they did in the past. That's right, grandma and grandpa are living longer, so they're not willing to sell their homes so fast. Don't get me wrong, I'm a grandma, so I can say these things. So let's take a look at pre-existing home inventory. Now here again, we have a chart that goes back to 1999 to current date. And you'll see again, right around the crash, let's say 2007, we had over 4 million pre-existing homes on the market at any given time. And let's speed up to 2023. We have a quarter of that. We were at our lowest amount since 1999 in just last year, 2022, and we are slowly climbing back up. And as you know, until rates go down to entice those homeowners with that have that nice 2% interest rate, we're not going to see a big jump in inventory for pre-existing homes. But wait, there is hope for the future by looking in the past one more time. This next chart explains how a homeowner's mortgage versus their equity is working. If you'll see here, if you had a homeowner who bought a home in 2010, it took them about 5 to 6 years, even in a bad economy and bad housing market, for them to start seeing equity in their home. And then as you go along, you can see that the average homeowner in the United States is sitting on around upwards of about $300,000 in equity in their home. Now, how do we get those homeowners who are sitting on these 2 and 3% interest rates to decide to move and use that equity in their next home? That's going to be rather difficult, but I know that there's a way, and let me show you. Right now, we realize that current homeowners are sitting on a rather large amount of equity in their home, this big pile of cash sitting between their walls, and they can't tap into it unless they do a cash out refinance, which then in turn gets rid of that 3 to 2% interest rate, right? But let's take a look at some of the pain points that a lot of these homeowners are feeling right now. So if you'll take a look at the top chart, it's personal savings rate. So the average homeowner prior to COVID was saving anywhere between 5 and 10% on top of their monthly budget to put into their savings account. And then COVID hit and nobody could go anywhere or shop or do anything or leave their homes in some places. So their savings actually went up, right? And then you add the even better 3 stimulus checks. So if you'll see those 3 spikes in this chart, you can see that there's 3 spikes, and those are the stimulus checks that went out. So people were using that money because it would go back down in regards to their savings and then spike back up again. And then you'll see after about July of 2021, everybody's savings account even went down to its lowest point in July, which was below 5%. And I do see it starting to climb back up as we normalize. But you'll see that part of the reason for that dip was a great thing I like to see in credit card balances. So let's take a look at the second chart here below. These are the average credit card balance for a household. So back before COVID, we were sitting in a steady climb of around $84 billion in total credit card debt for the United States. And then COVID hit. And again, we couldn't go anywhere. We couldn't do anything. And we were getting all these stimulus checks. So what were we going to do with the money? People actually paid down their credit cards. And you can see that it dipped down to its lowest point in the past 7 years to below 760 billion. But then the stimulus money stopped. And the reason I stack these two charts on top of each other, you can see a direct correlation. So you can see that once that last stimulus check went out, we had that last dip in credit card balances, but then everybody started going out again and having to go back to work or find new jobs and a new way of doing things. And then inflation hit because we all printed all this money for stimulus, right? So then people had to start paying more for eggs and for toilet paper and all of the crazy things. And as our inflation went up, so did everybody's credit card balances. And we are sitting at the largest debt that America has ever had in credit card debt. And as that's happening, you have to understand the overnight rate, the Fed rate climbing directly affects the interest rate on your credit card debt. So as that's climbing, the debt's climbing, so is the interest you're being charged for those credit card debts. So that's the pain point. Let's take a look when someone objects to not getting rid of their 3% mortgage while they're paying 20 to 27% interest on those credit card balances. Does your client actually have a 3% rate? So what I did here on this chart is blend the rate. I have this available to do for most clients. So let's say we have a client who's sitting at a 3% interest rate on a $343,000 mortgage, but they have a $20,000 Visa, $20,000 MasterCard, Discover, Macy's, Nordstrom. If you'll notice, the interest rates on those based upon current rates are anywhere between 21 and 24%. So all that debt totaled up to $411,000, and then you blend that rate, you average it out, even including the mortgage, you've actually got a blended rate of 6.331%. So do they really have a 3% interest rate? No, you do not. And that's something that can be brought to someone's attention that really changes their mind, that as they only have a 3% rate on their mortgage, the rise in the interest rates on credit cards has pretty much wiped it out and made it worse. Let's take a look at if we are able to show this client how they can buy by buying up their next home and stop worrying about the interest rate, how they can truly save by getting rid of those credit cards. And here it is. The borrower's current rate is 3%. Today's interest rate, depending on what day you're hearing this, is at 6.75%. They purchased their home 6 years ago for $500,000. Their original loan amount was $400,000. Estimated home value today is $695,000 with a remaining balance of the mortgage of $343,000. The cost of selling the home, which means commissions to real estate agents, title fees, all of those fees to sell the home, is about $35,000, which means their available equity is $317,000. Proposed closing costs for the new home is about $12,000. So that means they have $305,000 available for a down payment. Now they are looking at a home for $850,000. They put that $305,000 down. They end up with a loan amount of only $545,000. Now, understand, yes, that monthly payment increases to $2,572. Now that's based upon principal and interest. The borrower reluctant to give up that 3% rate, but the borrower doesn't have any debt. This is where the magic happens. This is how I can help your clients see the true savings by going ahead and putting their house on the market. Stop worrying about that stupid 3% interest rate they're holding on to so tight and pay down some of their credit card debt, and they end up with a total budget deficit of $286. That's right. By selling their home at top of market, paying off those credit cards, still having a significant amount to put down for their mortgage for their new home that they've upgraded, they're actually going to save $286 a month. I don't know where that's a bad thing. And holding on to a 3% interest rate when you can pay off all of that high interest rate credit card debt and end up saving almost $300 a month, I think it's worth it. So this is the question I get asked multiple times a day. If rates are coming down, should I wait to buy a home? Actually, no. So I did $1 million. It's just because it's easy math. I know that maybe, your market might not have all $1 million homes. But let's take a look here. So a loan today for $1 million, you put 20% down, which would be $200,000. You have a loan amount of $800,000 on a 30-year fixed rate at 6.5%. Now, let's say they don't want to do it because rates are at 6.5%, and they're going to wait for rates to drop below 6%. So they wait 6 months. What happens? The prices of homes go up. So when rates are down, homes go up. So we've seen recently in the past 6 months a small dip in homes values in regards to properties that are on the market. I don't think that we're going to see that continue once rates start dropping. And we're actually going to see that increase of about 2 to 3% by the end of the year. So let's dig a little deeper in regards to mortgage rates and when they climb and when they come back down. So I did a chart based upon the average mortgage rate for the past 50 years. Why I did that is because I was born in 1972. Seemed like a good year. So if you can see, back in 1972, the interest rate was around 7.5%. And now we get to a recession. We saw rates go as high as almost 20%, about, I'd say 19% in 1982. And I distinctly remember being a child and my parents buying a home, and they got a 13% interest rate and they were ecstatic. Now, after that recession of 1982, you can see that interest rates started going down. And even in 1990, which that recession was due to Desert Storm, you can see that there was a slight spike up and then it went right back down. Same thing during the 2001, 2002 era, which was 9/11. And then you can see the large recession during the housing crisis. We saw things spike back up and then they went right back down. If you'll notice that we've slowly over the past, say, 40 years, have decreased our interest rates on average. So if you are less than 50 years old, you have no recollection of interest rates being above 7%. So you have to take this into a relative term, into history, that a sign of a healthy economy is actually interest rates between about 5.5% and 7%, which is where we are now. It just seems like a shocker because we haven't been there in a while. We've been very spoiled. But the biggest thing to see visually on this chart is when interest rates spike up, it is only a spike. It is not a plateau. They actually go up and go right back down. So don't hesitate to purchase a home now because rates are higher. I mean, the adage has been put out there several times, marry the home, not the rate, because most people refinance their homes over the life of their loan, not just once, but maybe 2 or 3 times, depending on what their current rate is versus where rates are at that moment. So as clients are hesitant because they're afraid rates will keep climbing, I seriously doubt they will. We're so far down that in order for it to climb, we would have to go into a major crisis mode. And I'm not saying I'm predicting the future, but statistically speaking, it's not as high as you think it would be. This chart is very similar to the previous chart, but I've added another line bar to it. So let's take a look. It's a trade secret I'm fixing to share with you. You can not have to call a mortgage lender and just pull up on Google the 10-year Treasury bond. Take whatever that rate is on the Treasury bond, add 2 points to it, and that was what we would say the average 30-year fixed mortgage rate was. And that's been since 1972. You can see that the light green line is the 10-year Treasury bond, and the dark green line is the 30-year fixed mortgage rate. They've been dancing together about 2 feet or 2 points apart, like little middle schoolers at a dance, over the past 50 years. So it's been pretty good industry standard that you could do that. Now, what has happened in the past year is there's been a bigger separation. Instead of predicting at a 2% difference, it's more like 3. So for example, if the 10-year Treasury bond today is at 4%, we would automatically add 3 to it. We would be sitting at 7. I don't know why that's happening. I have my hunches, I have my thoughts on it, and that's all that these are. So for the past 12 months, a lot of mortgage loan officers and banks have been selling a product that is a 30-year fixed loan, but buying down that first year or 2 years. What that means is if, for example, you've got a 30-year fixed rate at 7%, you can pay the difference between 7% and 6% for 12 months up front at closing and pay that lower payment for 12 months. And then it goes directly back to that 7% interest rate for the life of the loan. I think that we are seeing the industry trying to make up for the future. What does that mean? Well, we know that rates are going to go back down. Why do we know that? All the market indicators, the CPI report, the GDP report, the unemployment reports, all of those things have indicated that rates will be dropping in the future. And I think a lot of these lenders, what I mean by lenders is not me as a mortgage originator, but the people you make your mortgage payment to, the people who own your loan. How do they make money? They make money slow and long term. What I mean by that is the interest that you're paying on that loan, that is the profit that they are making. And if they've learned one thing from the COVID crisis is that in 2020, when interest rates tanked down to 2 and 3%, they actually saw all of these loans that they had used on their books as a slow and go income of anywhere between 4 and 5 and 6% that they knew that they would have for a while, because in history, that's a sign of a pretty healthy loan. They went away, they refinanced and went into these lower rates, and they may not have always kept those loans and refinanced them in-house. You may have chosen a different lender to go with for whatever reason. So they lost these loans. Well, they don't want to go through this again because they know the rates are going to go back down. So I think that they're hedging their bets and having a bigger gap between the 10-year Treasury bond and the current 30-year fixed rates. Now, again, that is only my opinion. And then you add these buy downs to it that they know that that's going to also refinance along with everyone else. And they're hedging their bets a little bit. Then you add the few days ago, the feds came out and is starting to require a lot of these big banks and big investors to have a little bit more money in their pocket, to be a little bit more secure, because they don't want to see any problems in the future when rates go down that they're not soluble. So that's just my prediction. We'll see what happens. I do think that we're going to go back to, at some point, the 2% difference between the 10-year Treasury bond and the 30-year fixed mortgage rate, but I don't know when that's going to be. So I just basically dumped a lot of data on you just now. So don't worry, you don't have to remember everything, but I do want you to remember the gist, the tips, the tricks, everything that I just showed you in regards to how you're going to help reset the narrative. Stop letting the talking heads on TV and in social media guide our business. You have to have these conversations with your clients. What a great way to make some phone calls and say, hey, I know that you're wanting to list your homes, but you're wanting to wait until rates go down, until the market gets better, or whatever the case may be. And I'm going to give you a QR code. And if you will fill out your name, email, and contact information, I will send you a buyer and seller's version of this video. It'll be a little less long and straight to the point, and I'll make sure that your clients will walk away with some great information to make an educated decision on if they're ready to list their home and go on to the next one. I appreciate your time. If you have any questions, please feel free to comment below, or you can go back to the beginning of this video where my QR code to contact me is. Again, if you're wanting to send this out to your clients and not have all of this data information dumped on them, go ahead and click the QR code and send me your contact information, and I'll be sure to share it with you. Thank you.